Hey everybody, I'm Alexis Meeks.
And I'm your host, Jim Cardinal. Happy Mortgage Monday.
So this week we're going to walk you through some of the different qualifications needed in order to get a VA loan.
Okay. Yeah, a couple weeks ago we talked about VA loans, and they're great loans, but this week I got a referral, and it got me thinking that, there are two things that are on VA loans that really aren't on a lot of other loans. The first thing was the fact that we count on VA loans child care expenses. I had this client, they called me this week, they had good credit, their debt-to-income ratio looked good when you looked at the traditional bills, but on a VA loan we do have to ask how much they pay in child care. And so, well, these folks had two kids and some form of child care and an expense of $800. So, a while ago, that was something that we could kind of get around. The veteran may say that they didn't have that debt or that they didn't pay, that a family member took care of them. But now we pull up a 4506s, and that's transcripts from the IRS. And what would we see, of course, on that, once we do see that?
Right, yeah, when you pull somebody's 4506, you're going to see all of their income and expenses, and the one thing that would be related to the child care is the dependent care deduction, where you get a little bit of a credit for those costs that you did pay.
Okay, so that's exactly it. And so the veteran can't say that they have no child care expenses when they are deducting them on there. So in this case, that person no longer qualified for a VA loan, which, it was unfortunate, but it was good that we found out in the pre-qualification phase of this versus 3 weeks down the line once the underwriter took a look at it.
Okay, and then any other qualifications? You did mention that there were two. Is there something else?
That's right. There's another one, and it's residual income, and it somewhat kind of makes sense. We don't have it again on any other type of loan, and that's residual is where they take into consideration how much money is left over. So they take out all their expenses, the new mortgage payment, they take out the child care expense, and they also factor in income tax, part of the income taxes, and actually the cost of heating the property and having energy for the property. So they'll actually need to find out exactly what the square footage off the appraisal, and so that they can just make sure that there is a certain amount. So it varies depending on area, but they need to have $450 or $500 left over in residual income left to make the rest of their payments. But so those are those two things that I think can backfire on people, especially if a loan officer hasn't written a lot of VA loans. They may not think of it. They may be just thinking of the regular expenses, but those child care, I'm telling you, that's something that's really on our radar screen to make sure that we're asking that up front, because you do not want to discover that 3 weeks down the line and then have to switch it to an FHA loan. It's better to do that up front so that the borrower knows exactly what kind of money that they're looking at. Again, VA loans are great, but they do have those two things there that can backfire on you. So, if you're getting a listing and you have a listing and a VA loan comes in, you might want to call the loan officer that sent in the pre-approval on the listing and just double check, make sure that they've seen those things. I never mind when an agent calls me, or a listing agent calls me, just to double check and make sure that the borrower's qualifications are there. And if of course you have any buyers, you certainly want to be aware of that as well. So this week, if you're out there, you have a VA deal, an FHA 203K, a regular FHA, or a USDA, think of me, Jim Cardinal, 281-0077. Make it a great week, and we will talk to you soon.